difficulties in accessing the markets for new bonds. So that was one problem. The other issue has to do with the state's credit and cash crisis. That in the past, our business model is very basic. We purchase single-family loans from lenders. We warehouse them, park them in a borrowing facility, and then take that facility out with a sale of bonds down the road once it's sized enough and makes sense to go to the bond market. Our main source of warehouse financing was with the Pooled Money Investment Board. And once the loans from that PMIB shut down in December of 2008, then that was when we ceased lending. And so for the past year, we have really not done a lot of lending. We put together one loan program where we sell loans directly to Fannie Mae on a cash basis, but that's pretty much at a market rate. And with other real estate lending issues going on, there hasn't been a lot of lending at CalHFA, either on the multifamily side or the single-family side for about a year now. So that's unfortunate. But the third problem with regard to the bonds is CalHFA over the years, well, since the mid-'90s, had issued some variable rate debt. The purpose of this is to lower the cost of borrowing for CalHFA so that we can pass that on to borrowers. When interest rates dipped to very, very low levels starting in early 2000, that decreases our ability to be competitive if we issue fixed-rate bonds. So the idea was issue lower rate, variable rate bonds, enter into swap contracts and fix the rate synthetically in the marketplace with swap contracts. And that worked very, very well for about 10 years. Then with the credit crisis, again, liquidity providers, the swap providers, the liquidity banks didn't do very well. They weren't performing well. That made investors nervous, and that caused some problems with our existing variable rate debt. We have about $5 billion of variable rate debt, about $8 billion in all. We have some fixed rate, some variable rate debt. So the variable rate debt that was not performing well is about $3.8 billion. So when we get to the federal assistance plan, that assistance relates to the $3.8 billion in variable rate debt. So the final issue, the fourth issue for us, does not have to do with the bonds per se. It is with our single-family loan portfolio, which we'll get into more detail at the very, very end. I know you want to spend a lot of time on the federal plan. I'm prepared to do that. But that assistance plan does not relate to the underperforming single-family loan portfolio. And just very briefly, with unemployment increases and with home price devaluation, it's made it very difficult for some folks to stay in their homes, and so we have increased delinquencies, increased folks in strategic defaults. That's become the word where you just decide financially I can't do this, I'm underwater, I'm walking away from my house. So we'll spend a little bit of time on that at the very end. We should, unless there are questions about those four issues, I think what I'd like to do is get right to the federal assistance program. This is part of the Obama administration's Making Home Affordable program. The authority was under the Housing and Economic Recovery Act of 2008, the HERA Act, and that authority expired on December 31. So all this had to be put in place by December 31. Treasury was involved, Fannie Mae, Freddie Mac support this, and the Federal Housing Finance Agency, which is the regulator and conservator for Fannie Mae and Freddie Mac. Finally, the decision was made. The program was announced on October 19. That gave us very little time to put all this together. We had some very tight timelines. Our staff worked very, very hard to put this in place. It was available not just to California, but to all HFAs around the country. Some took more advantage of it than others. We took full advantage of it. There are two components. There's the new issue bond program, which deals with the first problem that I talked about, the access to the bond market. And then the temporary credit and liquidity program is the second part of it, and that deals with our $3.8 billion of variable rate debt. So I'll talk about the new issue bond program first. The objective is simply to allow HFAs around the country, CalHFA specifically, to access the tax-exempt housing bond market. These are fixed-rate bonds only. For the single family, if you applied for $1 and got $1 of assistance under this program, that's really great. The U.S. Treasury will buy $1 of our bonds, but you have to go out to the private market at the time you draw on that and issue another 40 cents. So it's a 60-40 split, and you want to size this up. So when I tell you how much money we applied for and how much money we got, you have to think on the single-family side, we're going to have to go to the market with 40% more for the single-family side. The interest rate on these bond purchases by Treasury would be set at the 10-year Treasury, which is right now about 3.7%, and add 75 basis points to that. And then normally that would be our cost of funds, and then normally we would mark that interest rate up a little bit to help pay the bills and that sort of thing. And then the final thing is that you had to have existing tax-exempt allocation from the Treasurer's Office at CDLAC, the California Debt Limit Allocation Committee. That had to be in place, and we had that in place by the end of the year. So we were ready to go and put that in place. As I said, the timeline was all this had to be put in place by December 31, otherwise the authority went away. We just closed on the new issue bond program. We received $1.4 billion of assistance. We asked them for a little bit more than that, but we pretty much got all we asked for. The amount for single family is about $1 billion. And so that would support about, if you include the private sector issuance that we'll have to do, that supports about $1.7 billion in lending. Not sure if we can do all that because there is a little hitch to this program that we'll cover in just a second. And then there's about $400 million on the multifamily side. Here's the hitch. These funds had to be escrowed and made available by December 31st. We closed that yesterday. You get 3 bites of the apple. You can draw on that amount of money 3 times during 2010 only, because the next deadline is December 31, 2010. So 3 times during the year, we can pull money out of the escrow. You can use those funds anytime you want. So we could do a draw in late December of this year, 2010, and use the proceeds on into 2011. So we're viewing it as more or less a 15 or 16-month program of bond purchases by the feds. Again, we can use the proceeds to buy single-family loans, to finance multifamily loans, and to refund existing bonds if that makes sense in the marketplace. So we have decided to go ahead and put together a couple of loan products on the single-family side and begin taking reservations for loans in either February or March. We've got to put those products in place, and since we've been out of the marketplace for a while, we're going to have to get back in touch with our lenders and the partners from the past and say, we're back in business, and that's going to take a little while to market that. But again, just a word of warning. I mean, we can't just draw on this any time. We have to strategically decide 3 times during this year, and we also have to issue in the private marketplace. So we're going to have to see how that market improves during the year as well.
Can I stop you
yes.
there and ask just quickly? For a homeowner to access this loan,
Right.
would they have to be a current FHA loan that they would refinance, or could they refinance a conventional loan that they're upside down on into a Cal FHA?
Unfortunately, for all those folks out there who would like to refinance, our programs are for first-time home buyers on the single-family side.
These are only for first-time home buyers.
And this would be for first-time home buyers. Now, if they haven't if they've been a homeowner in the past and they haven't for 3 years, they qualify again as a first-time home buyer. But you cannot be a homeowner within the last 3 years. So if you have an existing loan, or if you take a CalHFA loan and refinance it, you're no longer, the first-time loan that you get.
So this will not help the people that are currently losing their homes.
Exactly. That would take a change in federal law. And that goes along not with state law, not with federal housing law. It goes along with the tax-exempt bonds, and it's the purpose under the Internal Revenue Code. Any other questions about the new issue bond program? Because I'm going to move on to the other slightly more complicated temporary liquidity. The benefit to borrowers at this point is this will have a pretty low fixed rate for us. One thing that we did they gave us the opportunity to fix the cost of these bonds for the year, and we took a look talked to our bankers, talked to their economists, and took a look at what everybody was thinking about for interest rates in the future, and we only saw them going up. I mean, everybody understands that interest rates are at a pretty low level at this point. So we decided to lock the rate of these bonds when we close. So that fixes our cost and allows us down the road that as the Fed stops buying mortgage paper and as concerns about inflation may increase, and as interest rates increase down the road, that only makes our product more and more competitive with the marketplace. So that helps us. So again, we're going to start taking reservations for new loans in about late February or early March, and we hope that we'll be able to offer competitive rates, and that'll be very successful. On the other side, the slightly more complicated temporary credit and liquidity program, the object here was for $3.8 billion of variable rate debt, we have in place standby banks, liquidity banks, that if on any repricing day on these variable rate bonds, the investors say, you know what, we just don't want these anymore, we want to put these back, rather than put them back to CalHFA, they would put them back to liquidity banks. Those banks are either not doing very well, charging an arm and a leg for what they used to charge, about 30 basis points, or they have gone out of business and they just simply don't want to do this anymore or can't. So this program will replace all of the liquidity agreements for all of those banks all in one swoop, and we will replace all of those agreements throughout the month of January and tender the bonds to Fannie Mae and Freddie Mac, who will be the standby liquidity backup for the bonds. But the benefit that we will have under this program that we do not have currently, and that is the United States Treasury said to all the state HFAs, will back that with credit support. So on all of those $3.8 billion of bonds, they now have the credit support of the United States Treasury, which is a good thing. These will now be AAA rated bonds, and they will price and cost us a lot less than they did in the past. So that's the big benefit here. It's not a forever deal, however. It is a 3-year agreement with escalating payments. The idea is that the Treasury and Fannie and Freddie thought that in 3 years, the credit markets will have come back to a point where we can go back out and get liquidity agreements again at reasonable prices. So they've increased the pricing, and if you're interested in the pricing, it goes from 50 to 75 to 100 basis points. And just for comparison basis, when we were having conversations with current banks about replacing these liquidity facilities as they come due in the next year, we were getting pricing in the 125 to 150 to 180 basis point cost. So this is significantly better. Now, I will go ahead and ask the question that you may be thinking, and that is, what happens in 3 years if things haven't improved? And that's the way we can always ask for them to renew this for another period of time with new pricing and all that sort of thing. I'm not sure that we get that, but if all else fails, what happens if we are unable to replace the Treasury and Fannie and Freddie's liquidity facility and credit support with other, then the bonds go to Treasury and they're owned by the U.S. Treasury. Now, if we did that for our current liquidity agreements, in a few months' time, if they weren't remarketed out, they would suddenly turn from 30-year bonds into 5-year bonds with a 5-year amortization. And so you would have all the loans that we have outstanding to multifamily borrowers and to single-family borrowers. Most of them are 30-year loans. They would be coming in on a 30-year payment stream. Suddenly, these banks would want to be paid off on a 5-year payment stream, and the math just doesn't work out. The agreement with Treasury is if they own these bonds, it's regular amortization for 10 years, for 10 years, and at that point, then there's a bullet payment. So the worst happens, this is a 13-year arrangement with the federal government, and at the end of 13 years, at that point, many of these bonds would be paid off, and at that point, at some point along the way, at any point during the 10-year period with Treasury, if we were able to do a refinancing, a restructuring of the bonds, that's permissible as well. So that's the whole thing in a nutshell. We asked for $3.8 billion of assistance on this and got $3.8 billion of assistance. So the total package between the $3.8 billion of temporary credit and liquidity support and the $1.4 billion of the new issue bond program is a total assistance package of $5.2 billion for CalHFA. And very, very welcomed. It solves the first 3 problems that I talked about for a temporary period of time, for this 3-year period, at which point we believe that things will significantly have improved in the credit markets, in the liquidity markets, and the tax-exempt bond markets. Let me see if there's anything else here on the... I talked about the timeline. We have completed all the new issue bond program requirements. That's sitting there waiting for us. And everything is closed on the temporary credit and liquidity support program. And all we have to do now is tender the bonds to Fannie and Freddie over the next few days. And by the end of January, all those liquidity agreements will be replaced. What they did in December was irrevocably commit to doing this. So at this point, they can't back out. All we have to do is make the delivery of the bonds, and that program's complete. So let me stop there and ask if there are any questions at all on either of the 2 elements of the program. And
Thank you. I want to take this opportunity to introduce and welcome Senator Huff, Vice Chair of the Senate Transportation and Housing Committee. Did you have any questions or comments?
I don't. Just happy to be here and learning more about where we are with our liquidity.
thank you, Senator.
Members? Senator Ng?
I'm just trying to understand the economy of this all, and there's 2 points that you could address. The first one would be, why is it that a state program suddenly needed to turn to the federal government? And the second is, how did you go from 30-year mortgages to suddenly having these short-term 5-year mortgages, and how does that affect the home buyers?
Let me cover the second one first, because the borrowers are unaffected by this program. So this all has to do with the bond side of the balance sheet. The borrowers make the same payments they had before, so there's no impact at all. For us, the impact is certainty. And for this period of time when the credit markets are in turmoil, it's getting better, but it gives us a 3-year period of time when we can know exactly what the pricing is and what the terms are of the liquidity agreement and how it's going to work. Not for the 3-year period of time, but really for a 13-year period of time. So there's no impact on borrowers. With regard to the first question, the reason for going to the federal government for help is that across the country, HFAs were just had complete inability to access tax-exempt housing bond market. Many of my colleagues around the country were in the same boat. They were not lending. Only if they had programs where they're delivering loans to Fannie or Freddie for cash were they able to do any lending at all. And the problem with those programs is that Fannie and Freddie are for-profit organizations. Didn't turn out that way for them, unfortunately, in a lot of it. But generally speaking, they price their products at market rates. And for us, there's no competitive advantage. That's not helping low to moderate income home buyers. So we need that tax-exempt capital to help us provide that benefit to borrowers. And there was just simply no access to that market at all. So that was reason number one. Reason number two was it goes back to the variable rate debt component. The variable rate debt offered the opportunity for us to offer lower rates to borrowers. That worked very, very well, but when it wasn't just a national crisis, it was really a global crisis, made that option, that those bonds, much more costly to us and to all of our HFA friends around the country. Really, the only national way to fix that was to go to the United States Treasury, Fannie and Freddie, and say, we need your help for a temporary period of time. So our national association started that dialogue. We are by far the largest users of the temporary credit and liquidity support because we're the largest state HFA in the country. But that's the reason to go for the temporary credit and liquidity support request.
Okay, so just to follow up. So in other words, what you're saying is that there isn't any California exceptionalism here. This is an issue that was affecting other states probably because they had their own pooled money investment accounts that were tied to the state of their budgets, and therefore there was less likely that the markets would do the loans, and so that's why you are seemingly dependent back on the federal government.
Right.
Is that in a nutshell?
Other state HFAs across the country are having similar problems. We could have each gone to our state legislatures, to our state governments, to ask for help individually. With this, especially on the credit support, there was so much benefit of having the U.S. Treasury stand behind the bonds that was the route that we decided to go with.
Well, that's the part thank you, Madam Chair, but it's from when and I understand December 2008, PMIB put a freeze $45 billion in projects. No, it was about $4 billion in state projects got put on hold. But then when they eventually did go to the market to sell California paper,
State of California,
and it was double tax exempt. I mean, they couldn't hold on to them fast enough. They just flew off the shelf. Right. And I'm just wondering, we didn't have that situation in December of this year. And so is the situation better now that in the future we wouldn't have to depend on the federal market, say 6 months to a year from now? Or do you see this a continuing problem that will come irrespective of whether we have a budget?
It's an excellent question. The idea of the program is for temporary help. Both the new issue bond program and the temporary credit liquidity support is all based on the fact that they believe that in a year or so, when the new issue bond program expires, that the tax-exempt housing bond market will have improved to the point where we can just issue 100% in the private market and not rely on the federal government. So that's that part. And then because there was so much turmoil in the credit and liquidity markets, They believe that that would take 3 years' time. But both of them are based on the assumption that down the road, at some point, and I'm not sure when that is exactly, that things will improve, that we'll be able to go back to the market for all of our financing needs and stop relying on the federal government.
Okay. Thank you, Madam Chair. I appreciate your time. I think I'm starting to understand that, but
Okay.
it may take years.
To clarify the point, the impact to the homeowner, there is no impact to the homeowner. They're still on a 30-year fix. It stays a 30-year. The impact will be only to the bond that we issue,
That's right.
taking it from a 3-year to 5 years.
There is one other point, though, that Mr. Ring brought up that I think is really important, and that is with regard to the Pool Money Investment Board, bond-funded programs, including some in HCD, rely on the state of California issuing bonds, and they have a, they had a period of time last year where they did sell some bonds. I'm not sure what that market's going to look like with the budget situation this year. But the Pool Money Investment Board still isn't available to us because they have loaned all the excess cash out there for projects and for whatever's bond funded. What we used to borrow is the excess cash that was sloshing around on the top of the bathtub, if you will. There's none of that anymore. That's all been drained out. They're issuing bonds and then funding programs. So if we want to lend this year, we have to find another way to finance those loans. And what we're going to do is this. And it has two benefits. One is it provides us with a warehouse line of credit, but it also protects us against loan losses in the future. What Fannie and Freddie will do is they will own the loans that we buy. They'll guarantee the income stream from that, securitize them, and so with the bond proceeds in the past, what we would do is buy whole loans and carry them on our balance sheet. That'll help us transition into the next conversation, but that's what we did in the past. In the future, what we plan to do is to securitize those. They'll be owned by Fannie Mae, guaranteed by Fannie Mae, and Ginnie Mae for the FHA loans. And we will buy a security that's guaranteed by Fannie and Freddie and Ginnie Mae in the future. We won't hold the whole loans. We'll service the loans and we'll work directly with the borrowers, but we won't actually own the whole loan. And what we're planning on doing is using an outside company to help us securitize those, and those folks will warehouse the loans for us in the meantime. So for this year, we still won't have access to Pool Money Investment Board loans, but that's okay. We have figured a business way around that.
So that would be investors owning these loans
Yes.
in banks or...
Well, not just banks. It would be Fannie and Freddie.
Yeah.
And with the New Year's Eve announcement that the United States Treasury will back Fannie and Freddie 100%, I mean, at this point in the United States real estate market, there's very little private equity that's invested. The Federal Reserve is through Treasury buying, most of what's going on in the United States as far as mortgage loans. Fannie, Freddie, and FHA back most of the loans that were issued in the past, and there's very little in the way of private equity now in any new paper that's going out for mortgages.
Historically, Cal FHA has had low delinquency rate on loans. Obviously, that has changed.
It has.
What steps have we, or is this new federal program going to help with that?
The answer to that question is no, not directly. It will indirectly in that it will lower our borrowing cost and help us ease our internal costs so that we have more resources to put towards this problem. But, overall the statistics in our loan portfolio, so now we're talking about the asset side of our balance sheet. We have roughly $1.5 billion of multifamily loans, and those loans are performing very well. We've seen some increase in vacancies. We believe that's for a variety of reasons. The economy, folks are consolidating families. They are living in homes that investors have purchased that were vacant, and they're being rented out at very, very reasonable rates, and they're preferring home living as opposed to apartment living. There's some evidence of that. But then on the other side of the house, there are the single-family loans. There are about $6.5 billion of single-family loans. It's about 32 or 33,000 loans. All these loans are fully underwritten, fully documented, fixed-rate loans. There are no subprime loans, no option arms. There's none of that business. So, and they were all made to low and moderate income home buyers. So So originally, these were affordable payment plans. So here's what's happening because of unemployment again, and because of home value declines. A lot of folks have decided that they don't have the money. Either they've lost their job. There were two-income families, and one spouse or the other has lost a job, or their hours have been cut back. And they simply do not have the money to pay. And so we've seen an increase in delinquencies. But we've also seen an increase in strategic defaults. And there's been some written about that in the press. And there were two articles in Wall Street Journal 1 week apart in December that talked about this, about folks deciding that
Just walk out.
just walk away. And it all depends on your view of what happens down the road with how your home recovers. But if in California, many homes have declined at least 50%, and the real question then is how long is it going to take me to get back? And if you had a house that you bought for $300,000 that's gone to $150,000, you now have to have a 100% increase in the value of your house to get back to square one, and folks just decided it's going to just take too long, and they walk away. Now, I don't have accurate statistics. We don't survey folks. A lot of the times we'll call and nobody answers. And when we get to the point where we actually go out to the house, they've been gone for several weeks. So we can't really nail down exactly what the size of that problem is.
But there are homeowners who understand that their home is worth only half of what it was. They're coming to us, they're calling our offices, asking for assistance. They know that they are upside down. They just want relief to refinance their home, maybe to a longer payment plan, taking it from 20 years that they have left to maybe 40-year loan. What kind of assistance can we give them?
Well, Di and I are taking these calls regularly as well, and
So are we.
it's that it is what it is, and folks have to
These are
make that
responsible people.
They are.
They have a responsibility to their community. They know what it will do to neighborhoods if they just walk away.
decision. Right.
And they don't want to do it.
The difficulty that we have, if we were a bank and you had stockholders and you had equity, and you could say, "I'm sorry, folks. I know that you thought you had." A $1 billion share of this company. It's now your stock's worth half what it used to be. That would be one thing, and private sector banks can make that decision. The problem for us in the conversations that I've had is, we borrowed money. We're a 100% debt capitalized mortgage bank. We can't turn to the bondholders and say, "I'm sorry, you're only going to get half of what we borrowed from you." So the conversation with the borrower is, "I borrowed money to loan to you, and I could do that because of the promise that you made to pay it back. So I'm not in a boat like your boat. I'm in the boat with you. We're all in partnership together." We have not been able to identify a assistance plan or pool of money that would allow us to write those balances down, to recalculate a payment on the basis of a lower. We have started 2 loan modification programs, however, one for FHA and one for conventional. And what we're doing is extending the term, and we're lowering the interest rate temporarily, and then it goes back up. And again, at some point in the future when we think hopefully the individuals will be able to increase their hours, get their job back, but we're trying to work with folks. I wrote this down somewhere.
People are not necessarily asking for you to write down, whatever their loss is. They understand their loss is their loss, but they are asking for, relief in making that longer mortgage.
Our bond indentures require a certain amount of money to be going into the bond indentures to go out for debt service payments. What we've done is, on the conventional side, is partner with Genworth, which is our loan insurance reinsurance partner. They're helping to fund the difference between the new payment and the old payment, and that's what goes into the indenture. What would be really terrific is if you could rewrite the loan payment down to whatever the current value is. We haven't found a partner with patient enough capital to do that yet. So we're doing as much as we can. In the loan, let me give you a couple of statistics about our loan modification programs. We've had 352 applications. We have 81 folks who are in a new payment plan or are making payments. 66 are in the process of being offered to borrowers. And what we do is we get their application, we look at their finances, we come back and we say, this is what your payment will be in the new plan. 37 of these applications that have been approved have been turned down by borrowers so far. So we have a pretty good ratio of acceptance.
Much better than Bank of America.
Well, I didn't want to brag, but from what I heard from the White House meeting, percentage-wise, I think we're doing much better than they. Another 175 have been approved by us and are off to Genworth because we're asking them to make the difference in the payment. They have to approve the plan as well. Now, they have not turned down one of these yet, but there are 175 that are back there being reviewed, and then they'll eventually come back out in a week or so's time and to be offered. So that's what's in the pipeline. I think it's been very successful. It's difficult because even on the FHA side, if you think about it from a bondholder's point of view, just straight business point of view, let it go. We get 100% check from the federal government. So, but I think what we've been able to convince folks to do is to try this. We've gotten help from Genworth to help fund the difference and make the bondholders happy. Both of these plans have been approved by our bond counsel, that they meet the technical requirements of our indenture. And Genworth actually has been very, very helpful. They have actually loaned us staff to go out and help with the non-CalHFA servicers. We service about 40% of our own loans, and so we know exactly what's going on there. What we have less control of is what's actually going on in the field with these other 60% of our loans that are being serviced by outside borrowers. We get some anecdotal evidence that they're not totally up to par, and we've met with Bank of America, Countrywide, and Guild and said, we're not happy with the performance we're seeing. We want a dedicated person for CalHFA loans, and they're coming around. But we're actually taking loans back from Citibank and what used to be WAMU, now Chase, and we're taking those loans back in because we're not happy with the way that they're working it. So Genworth has actually volunteered to put people on the job with us to contact these outside servicers and help them get loan modification applications in the door.
Well, it's progress, but not enough to help some of our homeowners that are losing their homes.
We're making improvements.
We absolutely are.
We've talked to loan services around the country. We were at about 2 to 3% delinquency about 24 months ago, and that was pretty much the case around the country. And all loan servicing operations had to go from basically you're processing checks that come in every month to full-on credit counselors, loan modifications, short sales, foreclosures, and it's completely transformed these. And we've taken existing staff that used to be involved in loan production, moved all those folks over, and really increased that. And we also have brief, we just started a campaign called Keep Your Home, where we are in constant contact with borrowers and say, think before you walk away. Here are the credit implications. We're not telling you what to do, but we're just telling you, consider these and call us for a loan modification before you decide to do that.
Is that information available to our district offices?
Yes,
Okay. All right. Thank you. Anyone?
and it's on our webpage as well.
Okay. Any other questions from members? Great. Well, thank you very much
Thank you.
for your presentation. Okay, Ms. Jacobs. Now we will hear from HCD Director Lynn Jacobs. Thank you for being with us.
Thank you, Madam Chair, members of both housing committees. I'm delighted to be here today. We did have some questions that came from the committee, so I'd like to address those first, but I'm open to addressing any questions you have on the activities of our department. The first question that you asked was about the Pooled Money Investment Board, and the PMIB are initials that really nobody had an idea what they were before the end of 2008. But in December of 2008, the board took action to freeze disbursements of bond funds. We, of course, are very adamant about wanting to produce housing and improve our job market and the economy. And after the PMIB freeze, which was issued in December of 2008, now they froze all disbursements. They did allow administrative expenses and interest on the bonds to continue to be paid. We were then unable to make any new awards. In the spring of 2009, the treasurer was able to do a bond sale. Assemblymember Eng was referencing that bond sale. And of that bond sale, we received $800 million in proceeds. But as of December, we were not allowed to make any more awards of any new funds. We did appeal and ask to make some conditional awards. So we made some conditional awards, which just means that the money will be reserved for those projects when money is available, but it's subject to the state of California having funds available. So it's a step along the rigorous path of financing a project. So keeping that in mind, we have $714 million in contingent awards under Proposition 1C, and those are awards to projects that are ready to go but are unable to start because we are not permitted to release their funds. We've all heard how challenging the housing market is, the construction market is. I'd like to just say that when I assumed this position in 2006, the residential construction industry had 960,000 jobs and was the #1 industry in the state, accounting for 11% of our gross state product. Now it's 163,000 jobs, a 72% job decline, and it's 1/3 of all unemployment in California. So there are a lot of people that could go back to work if we could help them. And unfortunately, for 2009, our building permits for the state of California, including single-family and multifamily, is 36,000 permits, the lowest number since records have been kept in California, which is basically the end of World War II. So we have a little ways to go. But Proposition 1C and Proposition 46 have been, great helps to the economy. And when we get more detailed statistics on those 36,000 building permits, we think there will be a much higher preponderance of multifamily building permits than single-family building permits, because we did have money out that people were able to invest in projects. And the banks were not quite as active in the market as we were. We have dispersed out of Proposition 1C, which is $2.85 billion. We've dispersed a total of $1,750 million, but of that, $714 million is those contingent awards that we have not spent. Okay? So we have approximately $800 million left to award in Proposition 1C, but part of the budget freeze letter in December of 2008, again, suspends our ability to make any new awards, whether they're conditional or not. Any questions on that?
Well, these shovel-ready projects that are waiting for $714 million to be allocated to them, is this the only part of the puzzle that is keeping these projects from going forward?
We have verified by talking to all of our developers that we have about $400 million in projects that are ready to go except for our money, that have their permits, that have the rest of their financing, and that...
and that equals to how many jobs? Do we know?
Our total, I believe we're talking about a total of 153,000 jobs for all of our awards, and we think these, just trying to find the number here. I do have the number. I think my staff doesn't know how old I am, and the print is too small here.
We can come back to that.
Yeah,
we can
okay.
come back.
I will, before the end of the testimony, I'll have that job number for you. Now, of course, as many of you know, we have quite a variety of programs under Proposition 1C, and over half of them, our funds are what we call takeout or permanent financing. So what happens with the developers of affordable housing is they come to us before they start a project, they get a commitment for their takeout mortgage funding, and then they take that to a local lender. It says, here, I've got my takeout funding, give me a construction loan. So over half of our funds usually are not needed until 2 to 3 years after we make an award, because it's for their permanent financing. They have to then make sure they have all their permits and then build the housing and meet our conditions of leasing up the housing, making sure all the improvements are done, like community centers, landscaping, those kinds of things, before our money gets in there. So our awards are way ahead of our spending money. Currently, of that $800 million allocation we got in the spring from the Treasurer's bond sale, we still have $530 million in our, I hesitate to say checking account, but in our account that is already set aside for us. And we haven't spent it because so many of our awards are conditional, and we can't disperse to those awards. So it's kind of a unique situation for us. We have money, we can't spend it, and we don't have enough money for everything. But given the fact that so many of our awards and our customers don't need their award money for 2 to 3 years, we think that we have a lot of cash on hand that could be invested in creating jobs and housing for people that need it. So that's Proposition 1C. Proposition 46, which was the housing bond from 2002, is $2.1 billion, and we have awarded all of those funds. We are looking at a small quantity of funds coming back on projects that did not succeed, and when we are able to issue award notice of funding availabilities, we will combine those with the same programs in 1C to get that last dribs of money out. But all the money was awarded once. When we look at our projects, in Proposition 1C, $850 million of that $2.85 billion was for infill infrastructure, and another $300 million was for transit-oriented development. Those were two new programs for us, and those programs have multi-use, mixed-use projects attached to most of them. They're complicated. Many of them are multi-phase projects. We have had many of the developers have challenges and delays in getting their funds out, but we have gotten very little money back. The way the legislation, the implementing legislation was written for the bond, the developers have 5 years to draw down their housing money. So we're still working with those developers to make sure their projects will succeed. I'm only aware of one project that is actually in foreclosure of all of our projects under transit-oriented development infill, and I believe the amount is about $3 million. So it's certainly not worth doing another round of our infill and transit-oriented development at this point. Those two programs are fully allocated. Okay, I'm breathing, so if there's a question. The other area that I think you wanted me to address is the federal funding that we get through the Neighborhood Stabilization Program. The Neighborhood Stabilization Program is a program that does not help people in their homes who are subject to foreclosure. It's an after foreclosure program. It's to buy, rehabilitate, and resell foreclosed properties as affordable housing. The first round of NSP was awarded last summer, and that's all spent, and cities and counties around the state are working with local nonprofits to get that money out. The next program that the federal government has is the second round of NSP, Neighborhood Stabilization, and we applied in the summer for about $23 million in funds with a coalition of some cities and counties in the state. Again, the use of these funds is the same as the first round, purchasing foreclosures, rehabilitating them, and reselling. The federal government was supposed to let us know if we got the awards by December 31st, and we're waiting by the phone. They have not done that yet. We do call them only once a week. I told my staff not to aggravate them too much. And so we hope to hear any day whether we're going to have funds under that program. The other program dealing with foreclosures at the federal level is their loan modification program. And their loan modification program, in my personal opinion, does not work in California because it only allows a 15% reduction from the loan principal. And that really does not help our borrowers in impacted communities, especially the Central Valley, the Inland Empire, and many others, because we're seeing a 50 to 100% decrease in the equity in the homes. So it's been a challenge for us because 25% of the foreclosures in the nation are in California, and we were hopeful that the federal program would actually work where the majority of the foreclosures were. So we continue to lobby at the federal level for a program that would actually be successful in California. So when you see that California is not taking a lot of that money, it's not because we don't want it, it just doesn't work in California. Okay. I'd like to tell you about a new program, only because you asked about it, but I'd like to tell you about it anyway. One of the things that was that's a very important initiative of the governor and the pro tem. We have AB 32 and SB 375, which are supposed to reduce greenhouse gases, but also allow for smart development and a jobs, housing, transportation balance. So we've developed a program that is, I think, very innovative in conjunction with the Resources Agency, the Health and Human Services Agency, and Business Transportation and Housing Agency, and many departments within, which we're calling Catalyst Sustainable Projects. HCD is partnering with Caltrans and the Department of Conservation and many other departments, including Parks and Recreation, Public Health. We have a whole list of them are participating with us in designating some projects around the state Good morning. I'll just start over on that one. Believe me, I won't go back to the beginning. Don't worry about it. Until I finish. Then I'll go back to the beginning for you, of course. I was just talking about our new program, which is our Catalyst project for implementing SB 375 and AB 32. What our plan is to designate between 5 and 10 projects. We keep saying 6. I don't know why. It must be someone's lucky number around the state that exhibit a jobs, housing, transportation balance as well as greenhouse gas strategies, and to incentivize those projects and test all these concepts to make sure they work. So HCD has $10 million for innovation and home ownership, which we are going to use as our contribution. Caltrans has money set aside, and Conservation has money set aside. The rest of the departments are going to provide technical assistance and bonus points in the appropriate funding programs that they have. Each one of the projects, of course, will be different and have different needs. Some will have parks, some will be transit stations, there'll be various different needs. The applications are out. They're due on February 15th. When we get the applications, we're going to have a committee of all of the departments that are participating, as well as the regional councils of government to choose the projects. So we think if we have some projects designated right away, hopefully by the end of March, that we can test some of these performance standards on greenhouse gas reductions, some of these new environmental materials that the salespeople say, save the earth, but we're not sure that they do, and test all these things, that we'll have some data that will be very useful as the Strategic Growth Council is developing the rules for implementation of SB 375. So even though it's a very small amount of money within our portfolio, we're very excited about that program. Okay. Now on to the permanent source. Unless there's a question over here so far? No? Okay. In 2007, Governor Schwarzenegger asked our department to help develop a permanent source of funding affordable housing that was not bonds. We're very grateful to have bonds, but they're very expensive, and we spend them very quickly, and then we have to keep going back to the voters, and it's a difficult situation. So what we did was convene meetings throughout the state. We had literally thousands of people attend the meetings. We were from Calexico to Chico, all kinds of places around the state, with many different sponsors of the meetings so that we got a good cross-section of suggestions. We asked 3 questions. What should we be spending money on? How should we distribute it? And then finally, where should we get it from? We had over 1,000 suggestions of sources from taxing people anytime they cross the border, to taxing mink coats, to all kinds of interesting suggestions. And we kept reducing the suggestions based on what we heard the most, and then we looked at what they would cost, what they would to administer, how much money they would raise, and finally what it would take to get them approved. So we narrowed it down to the top 11, which are on our website, and what we heard from all of the different communities, whether it was a chamber group, a teachers union group, an environmental group, a local government group, was that they would like to see money controlled at the local level as well as money going through the state. And we heard in every group that there was a concern that police, fire, teachers, and nurses be able to live in or near the communities where they work. So those are two key items to our proposal as it is unfolding. We're looking at roughly a 50-50 split between successful programs at the state that people like and use, and block grants to local governments to spend on affordable housing, not to spend on anything, that they can use for matching funds with our funds or their own affordable housing projects. So that's, we've been working with Senator Steinberg, and we'll continue to work with the legislature on figuring out the best way to make this happen. But we think it's a very important initiative. When we look at the statistics that I gave on employment or unemployment in the construction industry, and the need is there. You know, we read in the newspaper that we have too much housing in California. We may have too much housing in the wrong places in some communities, but we still have a population that grows at 500,000 people per year. And our statistics show that for 500,000 new residents, you need about 200 to 220,000 housing units. And as I said, we built 36,000 units in 2009. You missed my editorial comment that it's the lowest number on record for the state of California, is last year's housing production. Yes. That's when we started keeping statistics.
What kinds of housing of those 36,000? Well, 36,000 units, what kind of units will they be?
We have not gotten the breakdown on that yet, but my supposition is it's going to be much more multifamily than single family. That's combined multifamily and single family, because we were the only people lending.
That's right.
Last year. So I think it's actually, you know, if you did a study on ratios of affordable housing, it would look pretty good, because there was probably more affordable housing than market rate housing built. But it's a little too early in January to have all those statistics yet. But when we get them, we'll give them to both housing committees.
Okay.
But it's a real concern. It's certainly a concern of the business community that they're having a hard time keeping employees housed near business, especially in the high-cost areas. So it's a big challenge. So we're going to continue to work on getting a permanent source, and we hope to be able to work with your committee on what we're going to be doing. And then I have to mention one thing that's not on the agenda, which is yesterday the state adopted the first mandatory green building code in the country. It's called Cal Green. And we're very excited. It was written by our department for residential construction, and it includes, besides the green building, the energy-saving things that we associate with green building, a gray water code for...
Very pleased.
Yes, yes. So despite the challenges in the housing market, we are still accomplishing some very important things and really setting up the state for when the market comes back. We'll have all these things in effect so that our new construction will be much more environmentally friendly.
Let's talk a little bit about the governor's budget. And his proposed budget recommends transferring $4.2 million from the Emergency Shelter Fund. This is a fund that can be used for emergency shelters. And last year, the budget shifted $4 million of this fund that we were told would zero out the balance. So where is this new $4 million? Or is that one of the ponies that he's looking for?
Okay, first of all, it isn't a new and I believe it's 4.2 million to be exact. That's what they're telling us. This is the EHAP program, Emergency Shelter Program, which has been funded out of the general fund, as opposed to being funded out of a bond. Okay, and because it was funded out of the general fund, we had a very difficult time establishing how much money we had because of the interest costs in the general fund. And there was quite a back and forth between us and the Department of Finance on whether there was any money. Okay? It took a long time to find this money because I shouldn't say I always fight for money to go to housing, and whatever a reasonable person from finance says, I say, well, but we could use it more. So there was quite a debate on how much interest money we owed the general fund. So it was zero. And we kept saying, no, we think that there's some money there that's not accounted for properly. And it took a lot of work and time to identify this money. Okay? And we support the governor's budget. It's a difficult choice. It's an excellent program. It's an area where we have tremendous need. Every one of our housing programs is underfunded for the need in the state of California. But the governor's made some difficult choices, and I know you'll be working with him on the budget, and we'll implement whatever's decided.
Well, we all want to work, with him on the budget, but when there are pots of money, available that could have prevented some people from becoming homeless last year.
Yes,
Very disappointing.
it was not available as far as we knew. If it had been available, I don't know what I don't know what you all would have done with the budget last year. It wasn't much easier than the budget's going to be this year, but I don't know what you would have done with that money if it had been there last year. Mm-hmm. I don't know what you're going to do with the money this year, now that it's been identified. But the point is, it has been identified. The governor has made a budget proposal that includes using this to help with the general fund shortage, and we support the governor's budget. And, we'll work with you and the budget committees in whatever way.
Supporting the governor's budget is neither here or there, nor
Right.
is that up for discussion today.
Right.
What is up for discussion today is when we find those pots of money that we think did not exist, how do we fix that moving forward? That happened last year. Now we know that this money is here. How do we prevent that from happening again? Is there something that the department can do to ensure that all of a sudden, 3 years from now, we don't realize there was money there that we could have used to help families?
Well, it's an excellent question, and it's a great point. And I think that when we have a specialized program for one department that comes out of the general fund, the accounting is a little more problematic than when we're talking about bond funds, where we have total control over the accounting, and we can do it in 10 different languages and backwards and forwards, and we know where every dollar is. So, we continue to work with the Department of Finance to make sure that these things are identified. But I don't know if my I was going to say IT, and then my computer accounting people have found a way to see that this doesn't happen again. I know they're trying, but we have a very complicated computer system for the general fund, and I don't know that our department is the one that can fix it. But we've asked.
Okay.
We have asked, how can we make sure that these dollars get tracked on a daily basis so that we see how everything, and we get daily reports, or that we have access to get daily reports on the general fund. So that's what we've asked.
Great, thank you very much,
Okay.
and we can follow up on your progress.
Okay, great.
Yes, Senator.
Yes.
I missed your presentation, as you noted, but regarding any of the federal ARA funds, stimulus money, either what has already come to California or if there will be a second round, is any of that impacting California housing issues? Are we able to use it?
There has been a relatively small amount of ARA funding devoted to housing, and it has not been devoted to new construction of housing, which is where I believe we have the biggest hole.
How much has come in for housing? If you could give us.
We have under our jurisdiction about $80 million total, and it's for homeless programs, and it's to assist homeless families. It cannot go for building shelters or shelter operating expenses. It goes directly to the families. An important need. But we do not have, I don't believe, the infrastructure for serving the homeless that we need in terms of shelter facilities or operating expenses. You know, we think, of course, that none of our rehabilitation programs work unless people are safely housed. But it's very costly to provide good rehabilitation programs, job training, whether it's drug and alcohol rehab, as part of a comprehensive program to help people who are homeless or at risk of homelessness. And we have had, you know, a relatively small amount of funds going into California.
So that was $80 million in ARA funds, direct
Right.
relief to homeless?
Right.
Is that it?
Okay. That's it as far as what's going through HCD.
Okay.
I did make the mistake of reading all 1,100 pages of the bill, and it did get pretty late, so I may have missed something. But there is a lot of housing money throughout the bill that's not in the housing section. But there is $15 billion that's available for public housing authorities. It is mostly for rehabilitation and energy efficiency. And public housing authorities around the country can apply for that. We haven't seen any data on how much has been applied for California yet. You know, we expect to see that in the first half of this year. That's one thing. There is additional funds going through the Department of Food and Agriculture for rural housing. And our staff has met with the local representative of the USDA, and they've set up a meeting that I haven't had yet for me to meet with the head person to say, we want to work with you to see if we can make that complementary with some of our programs. What can we do to facilitate that? So those are the kinds of things. Plus, there is a large amount of money, and I apologize for not remembering the amount, going through the Community Development Department for energy efficiency for low-income housing. But that is for homeowners of low-income housing. So there's a lot of money. You can tell what coast this was written on. It's for weatherization. But basically, that's energy efficiency. So there's a lot of money that was kind of hidden around through the bill, but there isn't money for new housing construction in ARA that we've identified. It's certainly not coming through HCD.
Okay, thank you.
So let's follow up on, so with the ARA funding, how would we get a handle on, what you're saying, I think, Lynn, is that the money is either in the rural housing or energy efficiency, and that's
Right.
existing housing, really, is that not to
Right.
upgrade existing
yes.
housing?
Of the $15 billion for public housing authorities,
Yeah,
I
public housing.
believe $5 billion of it is for new construction. So that's where the only new construction money
$5
is.
billion?
$5 billion. This is
Nationwide.
nationwide, yes.
And when you talk about housing authorities, you're talking about local regions and city housing?
City housing authorities, some have joint housing authorities, like Sacramento has a joint city and county housing authority. Many cities have their own. many counties serve smaller cities and have a joint one for the smaller cities in their county. So it's public housing authorities as they're chartered under HUD.
And how would we be able, is there a role for us to encourage those agencies to be applying for it or providing some kind of resource or helping them know where to go or if they need it? What role can we play if that's the only money that's out there? And that's important money, though.
Yes, it's a lot of money. You know, we have been talking it up, so to speak, but I think it would be probably worthwhile if we could put together with HUD a Northern California and a Southern California workshop for housing authorities, and that's something on my agenda for the first quarter.
Sounds like an excellent idea.
So that we all feel like we're part of the greater world. HUD didn't have any budget to put any conferences on the last quarter of the year, which is why we didn't do it then. And they had no travel budget, and they had no, because the budget wasn't authorized until I think like December 18th of this year. So they couldn't do it. So we're still working with them. So that's, I think, what we can do is get the information out. We know who to invite. I mean, HUD has a list too, but we know who the people are that are in the housing authorities because they also take part in many of our other programs. So I think that's what we can do. And we will do that, and we'll report back to you.
Good.
By the end of the quarter.
Thank you. Okay. Assemblymember Bradford?
Yes. Ms. Jacobs, earlier in your presentation, you mentioned money not available for people in foreclosure, but after the fact,
Yes.
and for nonprofits to acquire housing. How is that money being distributed, and how much money is available, and how are we getting that word out as well?
I don't have the total figure written down. My memory is that California got a total of $193 million. I could be wrong on that number, and I will get back to you if that's not the number. I have so many numbers in the non-computer brain of mine that, but I'm pretty sure that's the total for California. A small portion of that came through HCD because we handle money for very small jurisdictions that don't have infrastructure. So most of that went directly to cities or counties. They are permitted either to use the money themselves to buy houses, fix them up, and resell them as homes to people who make low or moderate income families, or contract with nonprofits. So there are some nonprofits around the state that have gone to multiple cities and have contracts with multiple jurisdictions to do this. I have yet to hear of a city that is doing it themselves. Some have tried, and they've had the same experience that every citizen who's tried to buy a house in the last year has been, is that they call on a foreclosure and they don't get a return phone call. So it's very difficult to actually acquire a foreclosure because the banks have more property than they're staffed to handle. So I have yet to see the cities doing it themselves. The city of Los Angeles, for example, set up their own nonprofit for this purpose, and but most of the cities are contracting with existing nonprofits.
I guess my question again is, how is that word getting out into the communities? Is it the county, city's responsibility to notify, or is it through your department? Or, I mean, because this is the first I've heard of it being built.
I believe that the jurisdictions that are in your district are direct recipients. They don't get their money through us. And so therefore they don't report to us. They report directly to HUD. We have not been able to get statewide progress reports because we're not the intermediary. We're the intermediary on a relatively small but important amount of funding for other jurisdictions. We can certainly ask, and it probably would be helpful if the committee maybe asked with us, because I think you have a little stronger letterhead. So to see if we can get those reports, and I imagine, we're not going to get them real frequently, but if we could get them at least, semi-annually, that would be something.
Okay.
So we'll work with you to get those requests in.
Well, thank you. Any other questions? Senator Lowenthal?
No, I'm just real concerned about this, the fact 36,000.
Building permits. Mm-hmm.
There's no credit out there. You can't, we can't keep people in their homes. There would be an opportunity, affordability is occurring because prices have dropped, and yet people don't have an access to those markets. Those are private markets. They're not under your jurisdiction in any or ours. What role can we play to we do this stimulus money, but it seems to me, if we can't keep people in their housing, and I was kind of shocked to hear last night on the news that, and maybe it's because of this budget that Assemblymember Torres was talking about one specific part of it, but they're now estimating that in the Sacramento region, it's going to go from this year, we have about 12.3% unemployment. It's going to go to 13.5%. I mean, it's gone the wrong direction.
I heard that same statistic, yes.
It's shocking. And we're those that are the most in need. I mean, you take where the Assembly member and I come from, Southern California and the Central Valley are a different continent than some of the coastal Northern California part. We're in a world of hurt. Maybe there are pockets that are doing okay, but there are, if you target those areas that really are hurting, they are really hurting. And I just don't know what our role
Well,
is.
When I look at what HCD's mission is and our role, I think the best thing we can do is get every dollar out as fast as we can get it out.
Absolutely.
So we are always pushing to have these conditional requirements released and to get the money that we have out.
Well, that's why I asked you about what and you said about holding those workshops. At least it's not your money,
Right.
but that is in the same philosophy, helping those authorities get that money.
And the other money that's very important to us is on the economic development side, the community development block grant funds. Now, again, most of the committee works in larger jurisdictions that get those funds directly from HUD, but still, we serve a lot of horribly impacted small communities in the Central Valley, for example, and in Northern California inland, that those monies are key to get out. So the federal money, at least, we don't have any freeze on, so we're pushing that out very fast. So that's helpful. We are great supporters of the Enterprise Zone program, and we think that more enterprise zones in a difficult economic situation is something that could be considered. There are many communities, there's much debate about enterprise zones, but they generate jobs for the people who really need them, the hard to employ. So that's another program under our jurisdiction. We don't make policy on those programs. You do. So that's something that we could do as a stimulus. And, the Enterprise Zone program currently, there's probably a technical term, but to me, is automatically renewable. So at the end of 15 years, we reissue that same number of zones. You might consider putting in a 15-year zone but not having them renewable for the tax impacts. And 15 years from now, hopefully, it'll be a different world economically. So that's one thing that's under our jurisdiction. But I think, we've streamlined as much as we can on manufactured housing and getting mobile homes in. Nobody wants them at the moment, but, we're ready to make sure that when somebody wants one, we're there to make sure it gets installed safely and those kinds of things. But I think it's all about getting the money out. And see, the problem that we have right now with these conditional commitments, naturally the banks don't want to lend when the developer has a conditional commitment. So we're almost giving them help in not getting money out. You know, my experience has been that the state has always been able to sell bonds and has never defaulted on a bond. So I think a commitment from us or a conditional commitment from us should be good for the banks, but they want to see the money in an escrow account rather than anything else. Okay, I got the totals on the NSP program. The total that came to the state of California was $384 million that went to entitlement jurisdictions directly, and $145 million that came through us. So I was too low on the number.
Yeah, you said 80, I think.
Just want to give you the correct number on that. So, you know, we know that we have such a high unemployment that we talked about before in the construction industry that there are people ready to work.
Oh, yes.
That's getting a job started is not going to be hard if the funds are there. So I think that, you know, we really appreciate your concern and interest in helping us get money out and getting things back because, you know, in 2005, we did 208,000 permits. That wasn't that long ago.
Down
to 36,000. So, I mean, you know, the cascading effect of not building housing to so many industries, whether it's the landscaper or the person who comes and puts drapes in your house to, you know, to every manufacturer of supplies and equipment. It's just, you know, it's a mushrooming industry. So we'd like to get the mushrooms back blooming.
Well, thank you for your presentation.
Okay, thank you.
I appreciate it. We're now at the conclusion.
Thanks for the opportunity.
Thank you.
We're always very, very happy to come and talk to the committee on whatever question and concern you might have.
Thank you,
Thank you.
Lynn. We appreciate it. Okay, any other comments?
Thank you for holding this hearing.
Thank you, Senator, for joining us. And thank you to our newest member for standing tall and hanging in there through the entire hearing. I appreciate it. Absolutely. Okay, we're adjourned. Thank you.